Year to you. So what's your outlook for this new year, 2021?
Well, I think we're constructive. We think we're going to be some volatility here in the early part of the year, but as we get either everyone has either had COVID or has gotten a vaccine and we move forward into the back half of the year, we're very constructive that the economy is going to continue to grow. Most expectations are GDP growth rate north of 3%. So I think that that's very positive towards the economy and the markets in general. We think the first part of the year we're going to have some volatility as things kind of find their basis here, and also, COVID's kind of come roaring back, and we're not quite sure. In some parts of the country, it's pretty intense, and so we're not quite sure exactly how that's going to affect continued shutdowns and things like that. Certainly has affected the hospitality and leisure sector, but we think again the second half of the year is going to be fairly solid due to expected stimulus and expected COVID recovery. So overall on the year, we're pretty constructive.
Right. I see what you're saying. Stimulus and COVID recovery will help the back half of the year. I think you're right about volatility in the near term. And, just a lack of full clarity is part of the problem. I mean, even over the weekend, there was a write-up in the New York Post about banks and some of these big banks not coming back to New York City this summer and filling up their offices. In fact, it's probably more like the end of the year, and that it may even be 2022. Which brings me to one category of e-commerce. Everything from home, work from home, shop from home. And you think that trend is likely to continue. I know you have some picks, including Amazon and Visa and Mastercard and Shopify. But tell me a little bit about the big picture, why you think e-commerce can be so strong and continue.
Well, the thing is that people have gone through forced adaptation due to COVID. If you weren't shopping online before all this happened, you are now. And they're not going to necessarily go back. I think that there is a permanent change in how people are conducting retail activities. And as we begin to see people realizing, you mentioned the office space issue before, as companies are allowing people to work from home, people are relocating around the country. This e-commerce phenomenon is going to become really kind of standard operating procedure for most households, and people are getting used to it. So where before we were doing maybe 10, 11% of our retail trade on e-commerce, it's gone up to 16, 17%. At Christmas, we had about 25%. But I think that when you think about China and a lot of other places where it's around 25%, I think we have a lot of room for increased e-commerce activity of how people are going to shop. And the major beneficiaries are the companies we've talked about. Amazon's a fundamental platform for that. Visa, Mastercard get a piece off of every transaction that runs through them. So as that increases, you're going to see that. And then Shopify is the enabler for so many other people to get into this business. So we see this phenomenon having long legs and becoming a standard operating procedure for most households. And this is how we do a tremendous amount of our retail activity.
Yeah, I see what you're saying. I mean, would you own Amazon or Shopify, or would you own both because they're a little different from each other in what they do exactly?
They are different. Yes, they are different from each other, and we do have both of them in certain portfolios. So I don't know that it is particularly exclusive one or the other. Certainly, Shopify is a newer player. And it's one that people who might be a little more aggressive might look to. Everybody's got to talk to their own financial advisor, of course. But the point is that both of them are somewhat essential in being able to either put things on e-commerce or execute the purchase. So they both have a chunk of this that they're having, and we're seeing good growth that we think long-term for both of these.
Right, and the Visa, Mastercard, you probably think all of these can go up at least 10%. You'll tell me how much, but we showed some of the charts that you sent along. We just had up the shopping behavior where, how many people tried a new shopping method and different brands, and that they continue, the intent to continue, 76%, 77%, the intent to continue, I think was big. The shift almost online, over-the-counter medicines, snacks, household supplies. These are some of the areas. Alcohol, personal care products. I'm surprised you're not also out there recommending some of the snacks and household supplies and things like that. Why is it that you're picking what you are picking?
We tend to try to focus on what we call choke points. We focus on the things that are essential to executing the satisfaction of human desire. So it doesn't matter necessarily what product you're buying. You still have to do it on a platform. You still have to pay for it with some sort of electronic payment processing. So rather than try to pick exactly what consumer is going to buy what brand, we just know they're going to buy something, and we want to get a piece of whatever that is. So that's why we tend to focus on what we call the choke points in the supply chain, rather than trying to pick a particular type of detergent or food or anything like that. So that's where we focus.
I see what you're saying. Yeah.
Sure.
Yeah, the execution is more important than, I see what you're saying, whether you're picking which toothpaste. I get it. That being said, when you take a look at the low interest rate environment, which is likely to stick around, I mean, I know that we saw the 10-year go above 1%, and maybe we can drift higher, but this is a low rate environment. So are you generally bullish on the S&P 500 when you look at PE ratios? For example, I know you're looking at this low interest rate support and expansion in multiples. Tell me more about that.
Well, when basically you have really a zero or close to zero risk-free rate of return, the opportunity cost for the risk is there. You can kind of price things up at present value. You tend to see statistically we move forward to higher PE ratios, and very low interest rate environments can support higher PE ratios. So when people think about, my gosh, the market might be overpriced at this point, we think that may not necessarily be always as true, because with the low interest rate environment, people are saying the Fed's going to kind of keep it there for a while, and until with a lot of stimulus coming on top of it, we think that the market can support these higher PE ratios in the S&P. I mean, years ago you would think that a 20 or above 20 on the S&P was awfully high. Now, because of low interest rates, it's not necessarily the case, and so we think that that's part of our positive outlook here. We don't think the market is tremendously overpriced across all levels. Sectors are certainly out of whack in some places, but I think that in general, the low interest rate environment can support a higher PE on stocks when you look at their statistics.
Right, it's not apples to apples the way we would have thought, is your point, right? When you look at a 20 PE, exactly. You start to say, hey, that starts to get a little costly, 30 or 100, or, we see some of those. Which ones are out of whack? You use the phrase out of whack for some things that may be in a bubble or overpriced or frothy.
Sure.
What would come to mind?
And well, you have to take a look at each various sector. And when I talk about some things out of whack, it's almost more on the inverse side. You see some companies that have a lower PE. When you actually take a look at Apple vis-a-vis some of the other sectors, it may be at a situation where it has kind of a lower PE than some of them. So that tells you either we have some strength in that holding, or it's basically other companies have kind of run ahead of it. So when you look at it, again, everybody's got to talk to their own advisor, but when you look at these things across the board, you can see that some of these pricing could be more sustainable than people think. If they're trying to run calculations on risk-free rates of return, if the risk-free rate of return, the alternative on this is roughly zero, then you can price most things at present value, and that's going to account for the higher PE ratios, which makes it acceptable. Yeah. And then various sectors are going to continue to be, in this headline-driven environment, you're going to see some sectors really impacted until we get past the COVID issue.
Yeah. I really love the perspective. Dryden, thank you so much. Dryden Pence, Chief Investment Officer, Pence Capital Management. Thank you.